You finally have some money to invest. So you sit there staring at the screen, terrified. What if you buy today and the market crashes tomorrow? So you wait, and you wait, and that waiting is quietly costing you a fortune. Now for the part nobody tells beginners. Trying to find the perfect moment to invest is a losing game. Even the professionals who do this full-time get it wrong constantly. So what hope do you have guessing alone? But there's a simple system that removes the fear, removes the guessing, and quietly builds wealth in the background. It is called dollar cost averaging. In the next few minutes, you'll know exactly how to use it. Dollar cost averaging means investing the same fixed amount of money on a set schedule, no matter what the market is doing. $200 every payday, $500 on the first of every month. Same amount every single time. You don't check the news. You don't wait for a dip. You don't try to be clever. The schedule decides for you. Your only job is to keep showing up, again and again, like clockwork. Now for the magic. When prices are high, your fixed amount buys fewer shares. When prices are low, that same amount buys more shares. You automatically buy less at the top and more at the bottom. Think about that. The thing every investor dreams of doing, buying more when things are cheap, happens on its own. No emotion, no genius timing required. The system does the hard part for you while you live your life. Let's make this concrete. Say you invest $100 a month into a fund. Month 1, the price is $10, so you get 10 shares. Month 2, it crashes to $5, so now you get 20 shares. Month 3, the price recovers to $8, so you buy 12.5 shares. You spend $300 total, and you own 42.5 shares. Your average cost per share is about $7. Now for the punchline. The average price over those 3 months was $7.67. You paid less than the average just by spacing out your buys. The crash you feared actually helped you. This is why dollar cost averaging is so powerful for normal people. It turns a market crash from a nightmare into a discount sale. While everyone else panics and sells, your steady buying scoops up shares cheap. It also kills the single most expensive habit in investing, which is emotion. Fear makes you sell at the bottom. Greed makes you buy at the top. A fixed schedule shuts both of those voices up completely. And it removes the pressure of being right. You will never nail the exact bottom. Nobody does. But with dollar cost averaging, you don't have to. You just have to keep buying through the ups and the downs. Now you might think, surely investing it all at once is smarter? Sometimes, yes. Studies show lump sum investing wins about 2/3 of the time, simply because markets rise more often than they fall. But there's something those studies miss. Most people don't have a giant lump sum sitting around. They have a paycheck. Dollar cost averaging is simply how income actually works. You invest as you earn. And when markets are scary and volatile, dollar cost averaging keeps you in the game when lump sum investors freeze and do nothing. The best strategy on paper is worthless if fear stops you from ever clicking buy. So how does this actually work? Step 1. Pick what you're buying before you automate anything. For most beginners, that means a broad, low-cost index fund or a target date fund. Boring, diversified, and proven. Step 2. Decide your amount and your rhythm. Look at your budget and choose a number you can invest every single month without fail, even in a bad month. Consistency matters far more than the size of the amount. Step 3, and this is the big one. Automate it. Log into your brokerage and set up an automatic transfer and recurring investment. Money moves and buys on its own. You never have to feel the pain of clicking buy. Automation is the secret weapon. It defeats procrastination, it defeats fear, and it defeats the temptation to skip a month because the news looks scary. The robot doesn't read the news. The robot just buys. Now let me protect you from the traps. Mistake 1. Stopping when the market drops. This is the worst thing you can do, because a falling market is exactly when your fixed buys are working hardest for you. Mistake 2. Trying to time around your own schedule. You start thinking, I'll skip this month and buy more later when it's lower. Congratulations, you just reinvented guessing, the exact thing this system was meant to kill. Mistake 3. Picking a bad investment to average into. Dollar cost averaging into a single risky stock that goes to zero will still leave you with nothing. The strategy protects your timing, not your choice of asset. Mistake 4. Forgetting to increase it over time. As your income grows, your contribution should grow too. A raise is the perfect moment to bump your automatic investment up by $50 or $100. Now, it gets exciting. Combine dollar cost averaging with compound growth and time, and something incredible happens. Those steady, boring monthly buys snowball into a number that looks almost made up. $200 a month, invested steadily at a 7% average return, grows to over $240,000 in 30 years. You contributed $72,000. The market handed you the rest. And you did it without ever watching the market, without stress, without guessing the bottom. You just set the schedule and let time and consistency do the heavy lifting in the background of your life. So lock it in. Dollar cost averaging is investing a fixed amount on a fixed schedule, no matter what. It automatically buys more when cheap and less when expensive, and it removes fear from the equation. Pick a solid diversified fund. Choose an amount you can sustain. Automate it so emotion never touches it. Never stop during a dip, never try to outsmart the schedule, and raise your contribution as you earn more. That is the entire system. It isn't flashy, it won't make you rich overnight, but it quietly turns ordinary paychecks into real wealth, and it works whether you're a genius or completely clueless about markets. The investors who win are almost never the smartest in the room. They are the most consistent. They showed up month after month, year after year, while everyone else waited for a perfect moment that never came. So here's your challenge. Before this week is over, log into your brokerage and set up one automatic recurring investment, even $25. Just start the habit. The amount can grow, but the habit has to begin. Quick question for you. What is stopping you from automating your investing right now? Is it fear of a crash, not knowing what to buy, or just not having started yet? Tell me below. I read everyone. If this finally made dollar cost averaging click for you, tap like so more beginners can find it, subscribe so you catch a fresh money lesson each week, and send it to that one friend who keeps waiting for the perfect time.